Good evening, everyone. Today is July 1st of 2025. I am Ryan Herbert. Um, this is, kind of a little bit of our staff, so everyone, knows who we are here. Obviously, disclosure, this is informational. Any strategies that I talk about, anything that I talk about as far as returns is all hypothetical. Really, this just kind of is the commentary on the current market, the current economy, and kind of what Mike, myself, and the team here at Prostatis, kind of what we think. As of right now, this is something that we've been talking about for a while. Right now, income taxes are set to go up at the end of the year here. I know that the big beautiful bill, as it is called, just passed in the Senate and is now at the House to be voted on. What that'll do is that will extend out the tax cut that we've had since 2018. So really keeping the brackets low and keeping the amount of income that fits inside of each of those brackets pretty wide as well. Because as we can see here, right now, we have our 24% tax bracket, and how much income fits inside of that bracket is between 165,000 and 315. Whereas prior to that 24% tax bracket didn't exist. It was 28%, and that actually went from 153 up to 233. So if you were making $300,000 under the current tax law, you'd be in the 24% tax bracket. But if it were to change and revert back to the pre-2018 levels, that same $300,000, instead of paying tax at 24%, you'd be paying tax at 33%. As I mentioned, the bill passed the Senate earlier today, and is now in the House, and they are going to make their changes to it and vote on it and do all that fun stuff that politicians really like to do. Another big part is that right now the lifetime exemption for estate planning concerns is 11.2. It's inflation adjusted up to like 13.6. If the bill doesn't pass, that'll drop that back down to 5 million. After that, it is inflation adjusted up again until it's about 7.3 million. So there are some estate planning concerns that that we have for anyone who has larger net worths, especially if this bill doesn't actually pass, doesn't make it through. But it does appear that it will make it through in mostly intact in kind of its current form here. This is our equity and fixed market commentary. Really not any type of crystal ball, not anything that really tells me exactly here's what's happening, but these are just factors that we consider when we're making our decisions. Right now we are officially at the midpoint of 2025. We have a lot of economic uncertainties, including the possibility of more tariffs kicking in here at the end of this month, especially with China. And the current bill that's working its way through Congress is going to increase federal debt by about $3.3 trillion. And that's on top of the $37 trillion of debt that we have. Little bit of signs that maybe the labor market is cooling, but in the face of all these things, really the stock market is pretty much near its all-time high, really setting the bar high for what the stock market should do in the second half of the year. People have very high expectations of what the market should do, especially considering that this bill is probably going to make its way into law. It would be very beneficial if the tariffs were to decline and not increase as they're set to do on China at the end of this month. That kind of his pause. I'm hoping that once we have this big beautiful bill or this tax package through, that he now turns his attention over to tariffs and kind of getting back into that aspect. As I said, it's supposed to go up here at the end of the month. If the labor market stabilizes and inflation really remains under control as it, for the most part, seems to be, that'll be good for the market. But predicting those events to really, happen the way we want is pretty difficult to predict. So for now, we do have positive investor sentiment out there, positive earnings growth, but that remains, pretty supportive for the stock market and continuing up. But we have pretty high valuations. I think, NVIDIA and Planetary are, perfect examples of that. And this potential tariff policy are the current headwinds that we talked about, that I have talked about. And, if I go back to January and I go back to April, kind of what my underlying thought process is that once we finally had some type of tariff stabilization, we should see the market kind of turn around. And that is what happened in April when this pause on Chinese tariffs happened. And then if the tax package gets passed, I think we'll have, much more upward growth in the overall market. And that seems to be kind of what we're seeing. And, if the bill passes, we should see that. That being said, if the tariff thing happens and we go back onto high tariffs on China, I do think that we'll have continued volatility as that happens. Back in early April, they unveiled, the administration unveiled a lot of tariffs. But right now, the point of it is to key up trade negotiations with individual countries that are really kind of going on. But right now, the average effective tariff is more than 15%. And I've got to kind of move one thing off my screen here. Is greater than 15%. And really what that tells me is that it's almost as high as what we saw back during the Great Depression. The tariffs are certainly raising the prices of certain goods and cutting into the profits for businesses that don't really pass on those higher prices to their consumers. If that happens, and the higher prices would certainly lead to less consumer demand, which the U.S. economy is consumer driven. The more that people spend, the better we do. And that really, if prices go up, we have less spending, really could slow down the economy. Another thing that we do look at is the labor market. The labor market really is a key indicator in how we view economic output, and the present environment is kind of showing us an environment where companies have cut back on employment plans. They have cut back on hiring plans. So they're not hiring a lot of new people, but they aren't laying anybody off to any specific degree. And really what we're seeing, the job openings, which is our blue line here, has started to fade off, meaning less people are being hired. There's less hiring going on. But it is happening at a lower pace. It's happening at a faster pace than layoffs have risen. So we're not seeing an increase in people being laid off. And initial jobless claims have been trending higher rather slowly, but what we're seeing is that the continuing claims, meaning that the people who remain unemployed here, and these are our initial jobless claims, is our blue line here. We see it's now starting to tick up here at the start of this year and kind of continuing. But what we're seeing is that the continuing claims is trending higher, meaning that because what we saw is there's not many people hiring, the amount of people that are unemployed remain unemployed, and that number seems to be trending in a much higher direction. A lot of the GDP, our gross domestic product, is really tied to spending. And as long as consumer confidence can remain high, people feel good about the economy, people continue to spend money, remains kind of critical to the overall outlook that we have on the economy. And the strength of the labor market is one of the key supports. If we are all of a sudden start seeing new jobless claims, initial jobless claims trending really, really high, people being laid off at a higher rate, that is terrible for consumer confidence. People are going to be very reluctant to go out and spend money because they're going to be in fear that I may not have a job. I should hold on to my money. I should not spend as much money. And that really will kind of show us slower economic growth should that happen. Heading into 2025, one thing that I'm positive we're going to see is volatility. We're going to see continued volatility in the market until we have some type of resolution in the trade war, but we're also going to see increased volatility in the fixed income sector. And that's kind of what this chart here is showing us. This is something called the MOVE index, which measures volatility in the treasury bond market. We saw that it spiked really high here in early April as investors are really responding to changes in trade and economic policies and what's going on with the Fed and with interest rates. They have said that they're still considering a rate cut this year. So we're seeing a lot of price movement in treasuries. People are starting to move. We're really moving into treasuries in April when we were having, basically the bottoming of the market there. So kind of was having people moving into it, so driving the price of those up there. One of the biggest things that we look at is really what's happening to long-term yields. A lot of what we had seen for the past number of years was a yield curve inversion, where we have short-term rates, meaning 1 to 3 year treasuries, were paying more interest than you were on a 20 or 30 year treasury. Because you'd think that if I'm going to put my money away and lock my money up for a longer period of time, 10, 20, 30 years, it certainly should pay me more money in interest than it was if I was to tie it up for 1 to 3 years. Well, for the longest time, those short-term rates were much higher than the long-term rates. And any time we'd ever had that happen throughout history, we always had a recession. And we have not had a recession. A true recession is 2 consecutive quarters of negative GDP. We've had 1, we haven't had 2. So a lot of the economic indicators that we look at really have become disconnected from the market. And what we're seeing here with this chart here is that treasury bonds are finally getting ready to push above 5%, which is the highest level that we've seen since 2007. Really what this is showing us is that the bond market is signaling that adding to government budget deficits over the last 20 years, is when rates are low and inflation is low, is going to require higher yields to investors. That's why we're seeing rates start to pick up, because now they need to offer better rates to attract investors, because people have just been keeping their money in short-term CDs. They've been putting their money in high yield savings accounts. We expect the Fed to lower the rate 1 or 2 times this year. So that's going to start to bring it down. And I think that they're talking about doing it in July, but more likely that's going to happen in September of this year, when that's their next meeting, because they're really wanting to take a lot of time to evaluate the economy and look at what's going on with inflation, make sure inflation's staying under control. And one of the key things that I think that Powell and the Fed are waiting on is what's going to happen with tariffs, because if tariffs kick back in, prices are going to go up, inflation is going to happen, and they're not going to be able to cut the interest rate like they want to. Speaking of tariffs, the average time frame for a U.S. trade deal has taken about 18 months. And what we see here in this chart is a study that was done by T. Rowe Price through Bloomberg. The average length of the length of time for trade negotiations with the various countries, Colombia, Panama, Chile, Singapore, Peru taking the greatest amount of time, but 18 months is about how long it takes us to negotiate trade deals. So if you think about when all these tariffs really started kicking in the first half of the year, we're probably about 18 months, so not even halfway there yet on when these trade deals would get done. But really what we've seen is that international markets have been outperforming the U.S. market so far for the year. We had that very significant pullback the first part of this year, and now we're kind of recovering. But the U.S. stock performance for the most 15 years really did so well that not many people paid a lot of attention to the European markets, the Australia, Asia, the Far East. And so what we're seeing now is that people are, you can see this little tick here at the end. The blue line is the U.S. weight in the all country world index has started to fall off, meaning that people are starting to shift their money away from the U.S. markets. And we're seeing the Europe, Asia, Australia, and Far East areas of the world is where the money is starting to flow, and we're starting to see a tick up in that. This is the first time, like I said, in about 15 years since we've had this happen. This shift is happening in a lot of investor portfolios. Really, we're starting to now move money in our portfolios over into those international markets. One of the tools that we use to do it is the THIR fund. It is a sector rotationary fund where we can actually go into the various sectors of the S&P 500. We can go into the various sectors of the market, international being one of them. So this is one of the bright spots that I want to point out, that this is kind of where we're starting to flow some more of the monies into the portfolio into the international markets, because it has really kind of been a surprise for the overall market. But I think, like I said, when we have the tax bill passed, if that's what comes to fruition, I do think that that'll provide us some fairly decent upward momentum in the overall market. But the next big key is what happens with the tariffs and with China. So, we're still have to hold our breath here till the end of the month and really kind of see what's going to shake out. But cautiously optimistic on what's been going on in recent times. We've had some pretty, 2 or 3 good months here in the market now finally, and we're starting to kind of see a rebound in the overall portfolios. We're still about 0.5% to 1% under where the market is, but we've been catching up rather quickly in short time. So I anticipate we'll be pretty even with the market as far as performance goes, probably by the end of August, early September at that time. That's just kind of my guess, as long as we have positive momentum in the stock market. We don't have anything major happen like U.S. having direct boots on the ground involvement in the Middle East, or another trade war, another tariff war kind of ramping up. And that's kind of what my thought process is on kind of what's going on in the overall economy, what's going on in the market, the things that we're looking at as far as the equity portion of the portfolios. Obviously, we took a lot of protective measures with our fixed income. We're using those alternatives. We're using those structured notes. We're using those index annuities that say stock market goes up, we go up with the market, stock market goes down. We have that protection in place. And, I think that showed in the beginning part of this year where the stock market was down a significant amount. And when we combined the notes and the annuities along with the overall equity portfolio, we were down far, far less than the overall market. So that means we don't have as far to recoup when it comes to the market itself, so when it comes to those losses. But one thing I want to point out, as I have started to see a greater uptick in scams, in scam activity. I want to point out that if it seems too good to be true, it probably is. Scammers have become much, much, much more advanced. Agencies are not going to call you out of the blue to say, hey, something's wrong. They're not going to text you. I know in here in Maryland, the texts about your Easy Pass account, I feel like I get one a week saying my account is overdue. My wife's uncle lives next door to us. He gets them all the time, and he brings them over to me, and he says something, hey, that says my Easy Pass account is overdue. And I always say, hey, Richard, when's the last time you crossed the Bay Bridge that would make you all of a sudden owe $95 to Maryland? The toll is not that much. You don't drive around that much. They're not going to text you. They're not going to email you. They're going to send you letters. So you want to make sure that you're not just kind of responding to anybody that calls you saying they're from any certain agency. We recently had a situation where a client was contacted saying that her name came up in a pending federal indictment, and they needed to move their assets out of securities and into physical gold, because then their assets could not be seized. One of the big tip-offs is, when they tell you, don't tell anyone about this, don't tell anyone what you're doing, that's a key sign that there is a scam out there. So I just want everyone to be aware that the scam activity has really, really significantly increased, and the ways they're going about doing it is much more advanced. The English has gotten a lot better. I mean, it used to be you could just read what they're writing, you could read the text, and it was very, very broken English, and it didn't make any sense. But they've gotten a lot more advanced, and they've gotten a lot more creative about the ways they're doing it. The one client in particular, they mimicked a government agency's website perfectly. They created badges, they created letters, they created all this stuff. But the overall goal was to, basically extort money from somebody, get them to convert it to gold, and have it physically delivered to a specific location, and then, that money's gone. But I want everyone to be aware of what's going on. And that really kind of wraps up everything that I have this evening. If you have any questions, feel free to give me a call at the office, 410-863-1040, or, you can email me at ryan@prostatisfg. If you want to talk about anything that I talked about tonight, or if you want a copy of the slideshow or the recording of kind of what I have here. But thank you, everyone, for, logging on and spending this brief amount of time with me. And I hope everyone has a wonderful rest of the week and a safe and happy 4th of July. Thank you, everyone, and have a good evening.